Didier, what are some of the key considerations for investors when they buy equities?
I think there are a series of elements to take into consideration that are mainly into the category of value investing. You need to look at the cash flow of the companies. You need to see the project that the companies are running, and the valuation. I think the valuation remains a good marker. But there are a certain number of misconceptions, however, to be careful. Some people say that the markets on a cyclically adjusted are expensive. It may be true when we look back vis-à-vis the history. But the point to consider is that we are really in exceptional monetary stimulus, and that we have no precedent to really compare with. And the fact that we are in a cyclically adjusted expensive level reflects the fact that there is a huge premium linked to the fact that we have a huge monetary stimulation. So that's one of the conceptions we need to explain to the client. The second element to be a little bit critical is about the dividend yield, because strangely enough, the dividend yields is very low and has not picked up with earnings. So meaning that there is a lot of retained earnings into the company. And some investors that are keen on getting income from their equity may be disappointed with that. But the point to consider there is that the retained earnings has a cumulative effect on the future value of the company. So that's also something that needs to be explained to the client in order to really make the steps towards company that are maybe at the moment not very, ready to give, what is called the bird in the hand, which is the dividend.
Didier, what would you say is a good guide in terms of allocation to equities?
Let's say a balanced portfolio with 40% equity, 40% bond, and the rest in cash and in alternative investment is, if we look back over the crisis, the strategy of a balanced portfolio has outbeat all the single assets like equity. It has beat the equity, it has beat the bond-only strategy, and this for half the risk of the equity. So meaning a balanced strategy, whatever your age, is probably a good approach, because if you follow the age rule and you apply it in an expensive bond market, you may be caught on the wrong side. So there is no silver bullet on that. It's important to consider also the relative level of the expensive level or cheapness of the asset class.
What is your view on whether investors should get exposure to equities in terms of via ETFs compared with individual stocks?
Investing is a knowledge experiment for any investor. So over the age, you start with little experience and you get acquainted with more sophisticated assets, and you make your mistakes, and you have your moment of glory. And I think there is no, linear approach. I think starting as an investor and buying ETF and being stuck in ETF for the rest of your life, you will learn nothing from your style. So I think in the process of managing the money, I think the ETF has certainly a role where there is very limited proximity vis-à-vis the investment. Meaning that if you are from Netherlands and you want to invest in Korea, having the right stock will be kind of a perilous exercise. But buying an ETF might be buying at the same time market diversification and a simple, very cost-efficient approach. But beside that, on the investment, where you have interest, where you have personal interest, it makes sense to follow your own instinct and your own intuition in buying into certain companies, because you will build knowledge related to this business, and this knowledge has a value for your investment. So I think there is no easy rule there. There is ample room for a good balance between, let's say, pure market exposure and targeted exposure into specific equities.